Welcome to Mortgage Map. As a first-time homebuyer, one of the most important decisions you will make is choosing the type of mortgage that fits your financial profile. While there are several niche loan programs available, the vast majority of buyers end up choosing between two primary options: a conventional loan and an FHA loan. These two options represent different pathways to homeownership, each with its own set of rules, benefits, and drawbacks. Choosing the wrong loan type can cost you thousands of dollars in unnecessary fees, or it could prevent you from qualifying for a home altogether. Today, we are going to compare conventional and FHA loans side by side. We will break down credit score requirements, down payment minimums, mortgage insurance costs, and property guidelines using clear dollar examples, helping you determine which loan structure will save you the most money. First, let us examine conventional loans, which are the standard mortgage option for buyers with solid credit histories. A conventional loan is a mortgage that is not backed or insured by the federal government. Instead, it is offered by private lenders and typically adheres to underwriting guidelines set by two government-sponsored enterprises, Fannie Mae and Freddie Mac. Because the government does not guarantee these loans, lenders view them as higher risk, which means they enforce stricter qualification criteria. To qualify for a conventional loan, you generally need a minimum credit score of 620. If your credit score is in the high 700s, you will receive the lender's best interest rates. One of the biggest misconceptions about conventional loans is that you must put down a 20% down payment. In reality, first-time buyers can qualify for a conventional loan with as little as 3% down. For example, on a $300,000 home, a 3% down payment is $9,000. However, if your down payment is less than 20%, you must pay private mortgage insurance, or PMI. The cost of conventional PMI is highly dependent on your credit score and down payment amount. If you have an excellent credit score, your monthly PMI payment will be very low. The greatest benefit of conventional PMI is that it is temporary. Once you pay down your loan balance to 80% of the home's original value, or if the home's value increases through market appreciation, you can request to have the PMI removed. This means your monthly mortgage payment will automatically drop once you build sufficient equity, saving you money in the long run. Second, let us analyze FHA loans, which are designed to make homeownership accessible to buyers with lower credit scores and limited savings. An FHA loan is a mortgage insured by the Federal Housing Administration, a government agency. Because the FHA promises to repay the lender if you default on the loan, lenders are willing to accept much higher risk. This government backing allows for much more lenient qualification guidelines. You can qualify for an FHA loan with a credit score as low as 580 while putting down a down payment of just 3.5%. If your credit score is between 500 and 579, you can still qualify, but you will be required to put down a 10% down payment. Let us look at the down payment on a $300,000 home. A 3.5% down payment is $10,500. While this is slightly higher than the conventional 3% minimum, FHA loans allow the entire down payment to come from gift funds provided by a family member, which is a major advantage for buyers without personal savings. FHA loans also allow for a higher debt-to-income ratio, often permitting your monthly debts to consume up to 50% or more of your gross income. However, FHA loans come with a significant cost trade-off in the form of mortgage insurance. Every FHA borrower must pay two types of mortgage insurance premiums: an upfront mortgage insurance premium, or UFMIP, and an annual mortgage insurance premium, or MIP. The UFMIP is equal to 1.75% of the loan amount and is typically rolled into the total loan balance. The annual MIP is an ongoing monthly fee, usually 0.55% of the loan amount. Most importantly, unlike conventional PMI, FHA mortgage insurance cannot be removed if you put down less than 10%. It remains on the loan for the entire 30-year term, meaning the only way to get rid of it is to refinance the loan into a conventional mortgage later. Finally, let us compare these two loan options side by side using a real dollar example to see which is best for your situation. Imagine you are buying a $300,000 home. Under a conventional loan with 3% down, $9,000, Your loan amount is $291,000. If you have a strong credit score of 740, your interest rate might be 6.5%, and your monthly PMI might be $75. Your total monthly principal, interest, and PMI payment would be approximately $1,914. After a few years, once you reach 20% equity, that $75 PMI drops off, and your payment falls to $1,839. Now, let us look at the FHA option for the same home. With a 3.5% down payment, $10,500, your base loan amount is $289,500. Adding the 1.75% upfront mortgage insurance premium, $5,066, brings your total loan amount to $294,566. Even if FHA offers a slightly lower interest rate, say 6.25%, your monthly principal and interest payment is $1,813. Adding the monthly FHA mortgage insurance of 0.55%, $133, brings your total monthly payment to $1,946. Over the life of the loan, this FHA mortgage insurance never goes away. Therefore, if you have a high credit score and can afford at least a 3% down payment, a conventional loan is almost always the cheaper and more flexible option because the mortgage insurance is temporary and cheaper. However, if your credit score is below 620, or if you have a higher debt load, a conventional loan may be unavailable or prohibitively expensive due to high interest rates and PMI premiums. In that case, an FHA loan serves as an outstanding tool to get your foot in the door of homeownership. By comparing these options carefully, you can choose the loan structure that aligns with your current budget and long-term financial goals. Mortgage Map is a calm guide for first-time buyers and curious homeowners navigating the home purchase process. The channel explains down payments, interest rates, closing costs, pre-approval, refinance, loan types, and common mistakes using real-dollar examples and simple visual layouts without giving financial advice. This video is for educational purposes only and does not constitute financial, legal, or mortgage advice. Mortgage rates, loan programs, and eligibility requirements vary by state, lender, and personal situation. Always get multiple loan estimates and consult a licensed mortgage professional before making decisions.